Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Through the Noise. Today I'm very happy to be joined by Fook Yien, who's a senior investment strategist at the CIO office. We've got a lot to talk about today. It's proving to be a remarkable week for equities and equity earnings. But earlier in the week, we also had the somewhat dramatic intervention in Japanese yen markets, which was a key event earlier in the week. So against that context, how should investors be thinking about their portfolios? Fook Yien, maybe let's jump right into the equities part of that topic. We've seen new all-time highs in global equities this week. What do you believe is driving this equities breakout, and do you think there's room for that to extend?
Yeah, I think we've seen a positive earnings and a softening US bond yields that have supported a breakout in major equity market indices. This shift is visible in the US, Euro area, and Japan equities, but also within the major Asian markets like China and India to varying degrees. This technical breakout has focused attention on an improving near term outlook after recent weakness. In the US, we see a strong earnings season has been a key contributor, with approximately 85% of the S&P 500 companies beating consensus expectations. And this is a great versus a long-term average of a 67% beat rate. In China, we also expect a positive earnings season as earnings reports kick off next week. Meanwhile, the pause in US real bond yields, that is yields net of inflation, that is also a key positive. Together, these factors argue that recent equity market gains have room to extend. While it is tempting to expect a return to concentrated sector or regional market gains, we believe the recent market rotations argue for keeping exposure more broadly diversified. We are also mindful of seasonal and US election related risk later in the year. So we retain an overweight view on the US and Asia ex Japan equities, as well as core holdings to Japan and Euro area stocks. However, this applies equally at a sector level. The S&P 500, for example, comprises approximately 45% in growth sectors, 35% in cyclical sectors, and 20% in defensive sectors. Our opportunistic idea on US communication services is a good example of gaining attractive exposure to growth. However, our recent upgrade of US financials on the back of higher yields and M&A activity reflects an attractive route to add cyclicals.
Thanks, Fook Yien. Maybe on that point on big tech earnings, what we've seen recently, big tech earnings, in your view, do they support the idea of a healthy AI investment cycle?
Yes, we think it does. We remain constructive on investing in the AI theme and express through our overweight to the US technology sector or via our opportunistic ideas on US communication services, MSCI Taiwan, and global power and electrification. A key concern heading into the big tech earnings was the ability to monetize the substantial AI investments. Now, the results so far largely suggest that AI investments are supporting real commercial demand rather than simply adding speculative capacity. And based on current trends, we estimate that AI related returns on investments for the big tech companies with strong cloud businesses is around 25 to 30%, indicating that returns are becoming increasingly tangible. While the return on investments remain attractive, we believe the uncertainty relates to whether hyperscalers have committed too much capital around AI too quickly. Now, this reflects concerns about the ability of hyperscalers to pause or reverse the investment cycle should the macro situation deteriorate. When the investment obligations become large and long dated, the market can become worried about execution risk just as much as return potential. However, we remain confident in the big tech companies' ability to manage their AI investments.
All right. Well, staying on the theme of technology, on the bond market side, what do you see as the implications of hyperscaler debt issuance for the U.S. corporate bond market?
Yeah, our view is that the shorter dated high quality bonds in the 1 to 5 year segment should remain relatively well bid, while the medium to long dated maturities face broader spread pressure. So we see an opportunity now to add to high quality bonds in the 3 to 5 year tenor. The US investment grade corporate bond market is experiencing an unprecedented supply surge this year, driven primarily by the major hyperscalers' AI infrastructure spending. June set a new monthly record for investment grade issuance at over 180 billion US dollars, with several brokers raising their investment grade issuance forecast for 2026. And this volume has created technical indigestion. So investors in the front end and medium maturities are absorbing new supply by recycling the redemption proceeds and coupon income. However, the asset managers and dealers are approaching risk limits in the belly and the long end of the curve, while insurers, who are historically the key buyers of long dated tech bonds, are or at near their target allocations. So, for hold to maturity investors, this presents an opportunity to lock in high quality income from highly rated bonds, especially in our recommended 3 to 5 year tenor.
Okay, well, staying with bond markets, we also had the US Treasury announce its borrowing plan and the Q3 quarterly refunding announcement. In your view, how does that impact US government bond yields?
Yeah, we expect the yield premium for the long dated over the short dated bonds to remain elevated, and we prefer the shorter tenor bonds, particularly in the 3 to 5 year segment. The US Treasury's Q3 2026 borrowing estimate of 739 billion is about 68 billion above the May forecast, and this really reflects deteriorating net cash flows. However, the yield reaction was mild after the borrowing announcement, which is likely explained by the continued heavy reliance on short term Treasury bill or T bill issuance amid the strong support from money market funds. T bills, they currently represent about 23.7% of the total outstanding debt for the US government, remaining below the peak of over 28% during the COVID-19 period. While the front loading of bill issuance, it keeps the short end rates anchored, it only delays but does not eliminate the eventual need for your longer dated bond auctions. The pressure on your long end yields is thus just being deferred. According to the US Treasury, a projected issuance will rise to $4.9 trillion by 2028 from $4.4 trillion in 2026. And because your longer dated bonds tie up investors' money for longer, they do carry more risk and put more strain on the market than short term bonds of the same dollar amount. Once this is accounted for, the extra borrowing translates into an equivalent of 350 to 520 billion dollars in additional 10-year US government bond supply per year, representing the true weight of new bonds the market will need to absorb annually. So the yield differential between the 2 and 10 year US government bonds has steepened materially in the past month, and this is consistent with the market pricing in a higher terminal rate at the front end, while the long end yield premium also expands amid supply pressure.
All right, and finally, we obviously had the yen intervention. In your view, what are the implications of this coordinated intervention for dollar yen, for yen funded carry trades, and indeed for Japanese equities?
Yeah, the coordinated US and Japan FX intervention, it has strengthened the credibility of official action, and it should limit sharp speculative rises in the dollar yen, the US dollar to the Japanese yen. The Japan's authorities, they appear focused on curbing disorderly moves rather than reversing the underlying trend. Japan's official FX intervention, it has changed the near-term market dynamics, but it has not altered our medium-term outlook for the Japanese yen. We still expect one more rate hike from the Bank of Japan this year, while the relatively high US interest rates should continue to support dollar yen. So yen funded carry trades remain fundamentally attractive given the still wide US to Japan interest rate differential. Although higher intervention risk, it may encourage lower leverage and tighter risk management. Policymakers they appear focused on limiting disorderly moves rather than defending a specific exchange rate level. So resistance is expected at around 159 and 160 in dollar yen, while support lies at the 156.3 and 155.23. With Japanese equities, we maintain a core allocation there. Consensus 2026 earnings per share growth has been revised materially higher amid a reflating economy and the ongoing corporate governance reforms. Against this, the volatility in the Japanese yen introduces a headwind as about 56% of revenues for MSCI Japan are derived from overseas.
Okay, well, thank you, Fook Yien. I think we've just about run out of time. Thanks for taking the time to speak to our listeners today. Top three takeaways from today's conversation. Number one, we would look to add exposure to equities on the breakout, but important to ensure region and sector diversification is maintained. Second, on the dollar yen intervention, the yen is likely to remain an attractive currency given the interest rate gap. And third, in US dollar bond portfolios, we'd continue to keep bond maturity short, whether in treasuries or high quality corporate debt. So thanks very much for listening to today's podcast. We hope you enjoyed it, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.